Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up. Now, if you're not on my email list, it's completely free. And to get on it, all you got to do is click the link you see on this video. It'll take you to an opt-in page, put in your email address. Then every trading day you'll get from me before the opening bell an email with the top things I'm watching before the market opens. Now, I want to talk about in this video a trade I just put on and the big picture, what's going on in these markets. I'm doing this over the weekend, but I think the headlines and the trends are going to carry over for more than just a couple hours or a couple days. And a way to do well in the market is to align yourself with that, because we're in a different market environment than we were 12 months ago. And that fact is summed up in this headline on the CNBC website. Inflation, rising rates, and the Federal Reserve could whip stocks around in the week ahead. Now, if you think back a year ago, the Federal Reserve was saying there would be inflation in the spring. Then they said it would go away. Well, that obviously it didn't go away. Inflation came and it only got bigger and bigger to the point where, as we're in the first half now of January, the yields on the 10-year bond have gone up, and the Fed fund futures market is projecting interest rate hikes, 2 to 4 interest rate hikes this year. A month ago, it was looking like July. Now they're pushing it out, pushing it forward to a good chance of one even happening as soon as March. But the bottom line is that the idea of whip stocks around, that doesn't tell you what direction the stocks are going to go in, but it does say volatility is going to be a defining factor, according to CNBC, of this week. I would say of the year when it comes to stocks, because inflation's not going away. Rising rates is not just going to be a trend or a thing. These are just themes of this week, but are going to be themes for the entire year. And that's making a lot of stocks now very tricky, but not making it impossible to put on good trades if you look beyond what most people have been doing 12 months ago, which is chasing Robinhood type stocks, the AMCs and so forth, that are no longer great trades. So let me talk about a trade I put on, and then a couple charts that got my attention right now, because I use charts to make my decisions, and I don't look at daily gyrations on an app, but I got to look at price data going back for a year and put that in context with even data farther back. That's how you figure out the trends, and not just try to react to a daily price gyration. So this is what I bought. FXE. This is an exchange traded fund that tracks the price of the euro. And I think it's very, nothing is 100%, but I think it's a good chance that this ETF is putting in a bottom. So I bought it, and I've got a potential mental stop loss order below 104. In case I'm wrong and this falls a point, let's say, I will get out. I've clearly defined my risk on the trade I'm putting in, and it breaks 106, then I think it's completing a bottom, and we're going to be on a rally for this that could last for months. So, and the thing is, if I look at the long-term chart, that's what I'm putting that action in context with. So this currencies trade differently than stocks. They don't go up and down 10% a day. I don't consider Bitcoin a currency. It does that. It's more of a speculative asset, but that's another topic for another day. Currencies tend to trade slowly and in defined trends that can last for months. So when they bottom out, typically it can take a month to form a base by going up and down, forming a base. And then they turn up through resistance of that base, the high of the base, and then can have a sharp rally. So if this ETF can close above 106, I will think that process has been complete, and we can look for it to go up, to the highs of last year, and then evaluate from there. So, of course, the euro trades opposite to the US dollar. This is priced in US dollars, this ETF. And if we look at the US dollar index, which not only tracks the euro, but the yen, the Chinese renminbi, the Swiss franc, it's a basket of currencies. It also has the potential to dip and complete a top here. The US dollar index peaked in March 2020. It fell into January 21 and then rallied, but that rally stalled out around Thanksgiving, and it's trading in a range. 97 is the top, and about 95 and a half or so is the low of that range, and could break down, which would mean that it's completing a topping process here. So it's trading in range. The next couple weeks will tell us, is it going to break out or break down? If it breaks down, that's going to provide a boost to the euro ETF. So it may be contradictory to you to think that the dollar could go down if this is going to be a year in which raising rates is going to be a story in the market. So how could that be possible? Well, markets trade ahead of other markets, you see. So it's possible that the dollar is just simply has rallied into a tightening Federal Reserve, and once the tightening starts, it kind of is done or starts to go down, because even if the Fed raises rates, it's very unlikely that it's going to raise rates above the rate of inflation, and that means we're still in a negative yield environment, which is why commodities are continuing to go up and up and up. So that's another chart I want to show you. But let's talk about the interest rate market. This is the yield on the 10-year Treasury bond, and you can see how that yield had a big move last year from January to April. That move was ahead of that CPI data. The Federal Reserve is saying, hey, there's going to be hot CPI data coming out, and yields rallied up. Rates, on the 10-year yield went up ahead of that event. Again, markets trade ahead of news. And then it went sideways, and now it's breaking out again. It's just closed last week at a high. Now, this is when CNBC says yields can cause, what was the word? It said whip stocks around. That's what happened last year. The 10-year yield shot up. And if you can recall, in February and March, the NASDAQ dipped roughly around 15%. The more volatile, speculative stocks fell even more. 20% declines across the board. The ARKK ETF, which typifies these type of stocks, had a sharp drop, and the ARKK ETF, by no coincidence, has been sharply dropping again since November. You see, when yields go up, that makes risky stocks typically go down. Now, when this happened last year, the NASDAQ didn't really start going down until February, even though the yields had been going up in January. Something similar may be lining up here, where the yields are going up, the market is volatile, weaker stocks are dumping, but the S&P is holding in. NASDAQ, it's weak, but I can't say it's dumping. If the raising yield continues, though, beyond the next couple of weeks, don't be shocked if the NASDAQ takes a bigger hit, and even if the S&P 500 takes something of a hit. But we got earnings ahead of us. People like to buy into earnings, so that's a positive factor. A lot of cross currents in the markets, making it very tricky to trade right now. And that's one reason why I like to look at this moment this year at alternatives to simple stocks. And ETFs like FXE trade smoother than the stock market. It needs to close above 106 to confirm my trade that I got on. So it's not, we'll see what happens. But that's the trade I'm in. But I like this trade much better than trying to buy and guess bottoms in stocks that are in free fall. And that's what the ARKK ETF is doing. It made a new 52-week low just on Friday. It's substantially below its 200-day moving average, and the 50-day moving average, which is the blue line on the chart, is now curved down. This means that this is lagging the market. The stocks that make it up are lagging the market, and most of those stocks are on the top 100 Robinhood list. This is the kind of stuff most people that are, Robinhood traders are in. These are fad stocks, volatile stocks that are very vulnerable because they're lagging the market. So if the S&P and NASDAQ dip, these stocks will get hit worse than the market averages. Very risky. Again, that's why I like at this time to look outside of stocks, look at currencies, look at commodities, look at stocks that benefit when commodities go up, and look at where, if you want to beat the market, get involved with what is beating the market. And that takes me to energy stocks. The XLE ETF made a new 52-week high on Friday. I own this ETF in my retirement account, and I own many energy stocks. The price of oil is trading up, and we're in a broad-based commodity bull market, beating the stock market averages, beating the ARKK ETF. Again, if you want to beat the market, be in the things beating the market. Which would you rather own? A stock like this, which is Robinhood, which is in a sharp downtrend, falling almost every single month and causing people to lose money, or a stock such as, I got to pull it up, I'm having some trouble, Exxon, which pays a beefy dividend, made a new 52-week high, and can go up because inflation is a big dominant trend of the year. I do own a position in Exxon. I've held it for like a year and a half now. And to give you another example of the type of things acting strong, this is the price of coffee. This is the coffee futures market. I don't have a position in it, just watching it, but this is an ascending triangle pattern. It looks like it's going to break out to the upside. That means coffee prices are, if it happens, they're going to go up again. They've been going up steadily, slowly in the grocery stores, but this is what inflation does. Inflation is a big trend of this year, and to beat the markets, you want to be in the trends that are strong and are part of the underlying conditions dominating the economy, dominating the financial markets. I would say that AMC and GameStop are fads. They're just quick trades in stuff. If you bet on inflation, you can hold if you're in the right stocks that do it, the right ETFs that do that. So these are the type of trades I'm looking at this week when I look through different stuff. And again, if you're not on my free email list, click the link you see at the video to get on it. And if you're just watching this video randomly on YouTube, subscribe to it, and then YouTube will send you a notice the next time I upload a video, and click the bell and they'll send that notice directly to your app or browser, I think, if you're doing that. And like the video, so YouTube will also know other people, hey, this is good stuff, that's worthwhile. This isn't a bunch of hype like most people are putting out there. So all that said, good to talk with you. It's going to be an interesting trading week, and see you in the next video.